So hi everyone. So today actually we are here to discuss about the market outlook for the month of June and beyond also. And we have seen various things are happening on the macro front, but on domestic front, our markets have remained quite resilient in the last 1.5 years. And now we have seen that once that stability is seen, the market is getting broad. We have seen that many sectors are emerging now. The participation is seen, and this is where going forward, this is going to be a very interesting market. This is what we believe. Even if the indices are getting flat over the period, though right now market is moving up, but it is also possible that after a few months, after making a new high, we may see again a consolidating market, what we have been observing so far. So in that case, we believe there are many opportunities in stock specifics which are going to come up, whether in certain large caps or even in small and mid cap space. So let's discuss about some of those opportunities, some of the macro things which are happening, and let's come to the conclusion actually what's our view then on the markets. So for the time being, let's discuss a different asset class, which is gold. We have seen a lot of buying by the central banks. If you observe here, actually in the last year in gold, and it also gives certain signal. It gives a signal that the central banks, if they are buying gold, there is a lot of skepticism which is there. And after many, many years, we have seen that this kind of buying has emerged in a single year by the central banks. And if this is happening, then we believe that there is some kind of skepticism over the war between Ukraine and Russia, some kind of skepticism over the slowdown scenario, what is emerging right now across the world, developed markets particularly. We have seen that this may be the reason why the central banks have bought gold. And if you see, this is one of those commodities which has taken out this 2011 highs. And obviously, it is looking very strong now. So it can spend some time, but eventually the trajectory of gold looks higher. And in that case, it seems that the equity indices going forward, they may have some kind of challenging times also. So the run-up in equities indices may not be very sharp. It may be more consolidating what we have been observing in the last 18 months, because S&P, for example, has already given up the gains. The last post-pandemic gain, it has already raised. It came closer to the pre-pandemic levels. But India is much higher actually than the pre-pandemic levels. So and this is where India is already outperforming. This outperformance is likely to continue because of the internal strength, our reforms, our policies, and then some volatility may be there because of the state elections. But eventually, the trajectory looks upward. But yes, it may be slow if the S&P is getting, a more flattish closings actually on year-on-year basis. So this is where more stock-specific market can emerge, particularly in India. And that is where actually we need to focus more. So Brent crude is one of the positives right now for India, because 3 supply cuts we have already seen from the month of November. But finally, crude has remained $75 around. It dipped actually before towards 70, but again moved up. But after the recent supply cut also, we have seen it is around $75. So this is where what we have noticed, that India is in a good position. Its current account deficit also declined, which was very scary actually before. In the month of September, it was very high, minus 4.4%. But now it has come down to minus 2.2. And it looks like for financial year 24, it should be somewhere around minus 1.9%. And this is where the currency can remain a little resilient now because of this current account deficit going lower. And so Brent is definitely helping the markets to remain stable actually, and which is leading to these kind of sectors which are emerging now. A good platform it is providing for that. Inflationary expectations are coming down. If you see the 1-year inflation expectation or 5-year, so they are showing that in US, it may be 4.5% in a 1-year period. In a 5-year period, it can be 2.5%. And that is the reason that Indian CPI also, the inflation is dipping. In fact, it is dipping faster than the US also. We have seen it is now 4.7%. US is still around 4.9%, but the trajectory definitely is lower. And that is the reason that now the interest rate seems to be topping out. And this is where many interest rate sensitive segments in India or sectors, they are coming out, whether it is automobile, whether it is real estate, and even some NBFCs, because when the interest rates are topping out, generally we have seen that some NBFCs, they start participating because of the cost of fund expectations coming lower. So if you see the US dot plot, it suggests 5.25% interest in 2023. And then there may be a cut in the next year, 2024, towards 4.25%. So considering this, US interest rates are already at 5.25%. And this is where we believe there may be more pause now going forward, maybe one rate hike, because maybe there. So that is something you cannot be very sure about. But eventually the trajectory looks like that this higher interest rate or sharp increase in interest rates is going to be halt now going forward. So as I said, good trajectory now. Now are seen in some of them. If you see, these are the new launches which have come up, and this is where the real estate, if the real estate is a good stimulus actually, because if real estate starts getting better, there is a lot of ancillary industries which start participating, and that is where it is really good for the overall recovery perspective, the job perspective in India. And this is very, very important sector actually, if we have to consider for the overall economy stimulus perspective. So when the real estate is doing better, obviously these ancillary industries, for example, look at the piping, pipe industry, Supreme Industries is definitely doing better. You can see here, this has shown actually a very strong volume growth of 15% year-on-year basis, which is higher than the market expectation. Market was expecting somewhere around 10-12%. It has come 15%. If you see the margin trajectory also, for the Q4 financial year 23, we have seen a sudden jump in the EBITDA margins from 13.1% to 18.5%. And the whole EBITDA is improving. So these are good signs from the margin perspective for these companies. PVC prices had come down. That is definitely helping. The demand is surging, as I said, because of real estate going up. Now, revenue breakup, if you see of this company, which is more into the plastics, PVC pipes and all. So we have seen the consumer products, packaging, industrial, all of them, they contribute somewhere around 34-35%. The plastic piping is somewhere around 68%. So this is where it is more dependent upon the PVC prices or the crude prices. If they are lower, it definitely helps. And this is where these companies are coming up now and are showing very strong results. Another example that you can look at is Kajaria Ceramics. It is also linked with the revival in real estate. We have seen that the input in ceramics is gas. If the gas prices are coming lower, the margins actually comes better for these ceramic companies. And you can see here the EBITDA margin actually, it was 12.2. Before it was 12%. So I almost made the bottom there and then reviving now, because energy prices previously were higher, but now they have cooled off, and that is coming actually into the margins. The revenues actually have picked up with the real estate cycle catching up. We have seen the ceramic volumes have actually improved. The revenues have improved. And it's a very significant 9.4% jump actually there that we have seen. So overall, this segment is one of those ancillary things that you can play along with the real estate. I think these kind of hidden gems, are definitely going to perform going forward now, because they have been consolidating for quite a while. And Kajaria Ceramics, which had a market share of 32%, it has increased to 36% also. So gain in market share by this company. Commodity prices are lower. So we have seen that the Brent prices have come down, and eventually we have seen there are other sectors also. For example, cement. In cement, we have seen the EBITDA actually has improved 200 to 250 rupees per ton kind of EBITDA per ton increase we have seen by the cement companies, which is definitely very good. The input prices, if you look at these are the coal prices, coking coal, pet coke prices, actually they have declined. So they are adding up to the margins of these companies. The only thing was that the cement companies were unable to increase the output price. And that is where these companies were laggard recently in the market. The Q4 numbers, we have seen good volume growth in these companies because obviously the activity has increased. They were close to 97% of capacity utilization. So more expansions are going to happen. And that is right. So I think the capacity expansion, which was expected, it was much, much higher in cement. So almost 13-14% of supply CAGR was expected, and the demand was growing by 9-10%. So there was a mismatch between demand and supply. But eventually, we have seen that if the margins are coming better, there is going to be some kind of reversal. And with the volume growth that we have seen in this quarter, these stocks actually have started reviving now. Paint companies, you have already seen Asian Paints, for example, decline to 2,800. Now, if you see the titanium dioxide prices, which is the crude derivatives, there is a decline in the prices of this commodity, which is linked to crude. And because of which the paint companies also are seeing the margin expansion now. And that is the reason that in the consumer space, the paint stocks have started participating now of late. Now coming to one of the stock example, taking from tire space, because in the auto ancillary, tire is one segment which is directly linked to crude. So if crude prices go lower, then we have seen that margin expansion happen actually in the tire companies because of the rubber which is used as an output for tires, and the rubber prices goes down actually if the crude prices also are lower. So in that case, we see that these companies, the margin expansion of 372 bips already we have seen in Apollo Tyre. It is one of the cheapest actually tire stocks available, and you can see here the price to earning on a 3-year rolling basis where it is now. So it is much lower, and if you compare with MRF and all, which are much costlier in this particular space. So we believe the earnings of this company are going to revive now, and this is a good example. If you see here, previously also from financial year 8 to financial year 13, the EPS remained lower, lackluster, and then there was sudden jump which continued for 3-4 years, and the stock also recovered in that period. And this time again, it is coming out of this period of lull EPS growth, and now suddenly you have seen that the EPS has increased. This is where you may see another 2-3 years or 3-4 years of cycle now in these tire stocks going forward. And Apollo Tyre being one of the cheapest, it can provide you a good alpha possibly going forward now. So another stock example where we are bullish is bearing companies like SKF. It's a good capital good setup where 50% revenues are coming from industrials, 50% revenues are coming from auto. And in the auto, we have seen the bottom possibly has made, and that is where the auto stocks are reviving with the interest rate topping out. This company has got Class K and Class C bearings now, which are used in the railway freight wagons. And this is where I think the going forward, there is a new addition in the revenues which is going to come up. And the best part is it is going in R&D now. So more innovation, more R&D, more value-added things, and more better margins. I think that is what we are going to see from this segment going forward. So we are very bullish on these kind of stocks. And we believe even if the market remain flat to positive, we may see a good recovery in these stocks going forward with the robust revenues, robust profitability, which looks like much better for the coming 3-4 years perspective at least. From the consumer discretionary, one of the major sector right now which is coming up is hotels, which is because government is also focusing on tourism. 50 nodal centers maybe they are now going forward, so it also caters to that. It also caters to the business travel which has increased. It also caters to the medical tourism which is increasing now. More people can come out to India or as a tourist also, not only as a medical tourism. So in that case, the hotels can perform better. And this was a sector which was not performing for the last whole decade, and it is coming up now. For example, look at Lemon Tree. We have seen that in this particular stock, that is how the average revenue, average room rates have revived. So you are seeing how the rates are reviving now. And I think this is a feature you will see going forward also. So as per the management, also the coming 5 years, now the coming 4 years now, this was the first year where the rate increase is going to be seen. And I think hotels can remain in the limelight. Valuations may remain higher for some time, and then you need to wait. If you are getting it at a better price, I think it's a good situation for a good win-win situation where you can create alpha. Now coming to the bond yields, because we have seen recently the bond yields suddenly had fallen. Indian bond yields came below 7% mark, and US bond yields also remain subdued, but it was more very tight range. But Indian bond yields coming down sharply means Indian markets are going to outperform the equity US market. So equity perform better when the bond yields comes down, and this is what happening here. And I think this is happening because the Indian government kitty is improving. We have seen very good GST numbers, right? 1.87 lakh crore. The number is going towards 2 lakh crores now slowly. We have seen good savings from the discounted crude oil taking from Russia, almost 85,000 crores plus of savings we have seen now. All of this is going to be there in the economy in terms of PLI benefits and all, more job creation. And this is where it is overall good for the economy if the bond yields are coming down. So this is one positive factor supporting the markets. And if you look at the banks, because PSU banks and all, they have been beneficiary of the lower bond yields because they have more bonds in their treasury. And if the bond yields are coming down, it's a good appreciation in the bond prices. And the credit growth also, along with that treasury feature, the credit growth in the banks also has improved, almost 15% of an average growth we have seen. I think the next kick is going to come from the industrial growth, because corporate growth has remained around 7-8%. It has recovered from the pre-pandemic levels of almost plus 1.5%. But still, it is much lower than the average growth, which is driven by retail, which is driven by SME. So we believe going forward with the private capex coming up, you will see that the current corporate loan book is going to revive now slowly, and that will create another kick actually for the banks. So banks right now, because of the NIM shrinking, you have seen more consolidation happening in the banks. But because of these features of repricing of the corporate loan, I think the NIMs may not shrink to that extent what market is expecting. So the EPS, if you look at in Nifty on quarterly basis, we have seen almost 2-year high EPS in this particular quarter. So this quarter was better than expectation. In one line, if I have to explain this, because margins have come better because the commodity prices were lower, and then we have seen a good volume growth in certain segments. And this is where the Nifty EPS for financial year 23, it has improved in double digit by almost 11% now, more than 11%. And it looks like that for the coming 2 years, financial year 24, financial year 25, there will be 14% plus kind of growth in the EPS. So in that case, we may see, a move towards 20,000 also in Nifty, in the coming months. So that is how the markets are now placed, and it's a good base of EPS recovery. And primarily banking and auto, they have really given a lot of impetus to this particular EPS growth in the index. We have noticed that there were a few trends before, like dollar was coming down, US inflation had started reverting back. This is the last quarter of the last decade. And then European prices also were cooling off. So still now, I mean, we are in the month of May, the dollar index is still subdued. It declined to 100. Now it is somewhere around 104. US inflation was, around 7. It has come down to 4.9%. European gas prices were somewhere around 33 euros. Now it has come down to 13 euros. So all of these factors, they have not worsened, rather they have improved further, which is good actually for the equity markets. And that is the reason that some risk on sentiment has emerged, despite 4 or 5 banks collapsed, regional banks in US, despite the Credit Suisse event which have happened, and one of the factors on the domestic front, I think, which Nifty was taking negative, was the lower rainfall expectation, El Nino impact. If suppose the lack of rainfall does not happen to that extent, then I think some of those sectors, rural linked spaces, which were not able to perform, for example, some FMCG companies, for example, some ruler based two-wheeler components, so they can also recover. They can see some demand recovery actually because of this. In US S&P earnings, if you see, so from Q3, you can look at here, there is going to be there is an expectation of revival. So we need to see how much the surge can happen in the US equity markets, which are looking more in a time correction right now. I think S&P is there to spend some time, but earnings, this is the expectation already building up, and that is where some kind of reversal we have seen in S&P from 3,400 to 4,300. And but yes, in the coming quarters, you may see some revival in the earnings of S&P also. This is what the expectation building up now. Now, if you look at the FDI or FII flows, so in India, one thing is very, very robust. The FDI flows are very robust. I mean, we have seen from 1947 till now, almost $950 or $1,000 billion came in India in terms of FDI, and out of which almost 50% has come in the last 6-7 years now. So it has gone into 61 industries. I think that is more promising. It is not that only few sectors are there, which was happening in the last decade when only few consumer sectors were performing. Now there are many sectors which are coming out. So as I said, in industrials, you have number of names, like, for example, you have bearing companies, you have automation companies, you have nut and bolt companies, you fasteners, for example. So there are many things there. In the consumer space, you have many luxury goods which are performing now, where this money has gone. So when the mass section was not able to perform in consumer, we saw the money went into the luxury goods and they started performing. For example, you look at the hospitals. So the premium hospitals, we have seen good recovery over there. If you look at clothing, so some kind of Shopper Stop or, those kind of companies, West Side, which are in the luxury segment, they have started performing. You look at the suitcase or bag. So we have seen Safari of the world has started, performing. So there are many things. So going forward, there may be some leaker companies. For example, United Spirit, which has sold some of the lower branded ones. So the premium brand leaker are there in their portfolio. I think they can also have some kind of reversal from these levels on the higher side. So this is where the luxury segments are, coming in the airline space, because crude oil is coming down and it has a big delta actually on the savings of airline companies. Margins can expand, and there are only one player which is listed now, which is a major player. Out of the players, I think this is the major player which is listed now, and I think that is all the money flow can move into that space now. If you look at India GDP growth now, it has surprised. It was better than estimates, and 7.2% has come despite all the macro headwinds that we were seeing actually on the global front. And this will increase more flows into the Indian economy also going forward, I think. And this is where I think if you look at many corporates, many companies from outside, for example, Apple, Tesla, eventually other MNCs also will come now in India. They are also going to set up the plants. And this is where you will see more manufacturing picking up. You will see more B2B segments coming up, the vendor companies. So it's not only the iPhone or Apple is coming and they will have their own fixed vendors outside, which are coming in India also, but those vendors also will have a good time actually going forward. So I think this base is improving now of manufacturing in India, and what is linked to it is the per capita income, so which is almost close to $2,300-$2,400. And I think with manufacturing and industrialization and infrastructure, so these two are the arms now. And because of this, the lower the spectrum people, I think there is a more possibility that these people can get jobs. For example, take the case of a person who is in the rural area. If the rainfall by chance is not good, sometimes we have seen these people, they come to urban areas, and if they are getting jobs in real estate, if they are getting jobs in infra, if they are getting jobs in some kind of manufacturing, and if these segments are doing good in the urban area, then they come and work and then send the money to their families actually in the villages. And that is where the consumption theme of the mass perspective, it starts working. So those things are linked, and that is how it develops. The capex in India, we know that 3.3% of GDP is a target, but that is how, if you segment from national highways to broadband subscribers to renewable electricity to railways. So we have seen from financial year 2006 to 2014 is this, the gray line, and from 2015 to 2023 is the blue line. So you can clearly see in the last 7 years now, approximate the kind of growth we have seen in the infrastructure space in India. And the fruits of this are clearly seen now, where we believe the profitability of these companies are definitely going to improve now. The debt portion is going to decline, has already declined, it is going to decline. And the money raising then can be much better for these companies, and which will add on to the further growth. And for this, the robust capital market is required, and which is very much prepared because it is getting broader now. The PMI Services and Manufacturing in India, services is more than 60% now. So you can see services is one of the best now, even when we look at the pre-pandemic period, 2018 2018-19 period. You look at the manufacturing, it is also in the top quartile now. We have seen it is close to 57%. So PMI Services and Manufacturing both are reviving better. The current account deficit, you are seeing 83. This is where the rupee had, USD INR had seen the sharpest depreciation in the month of October, November. And that time, the current account deficit was minus 4.4%. It looked really scary here that current account deficit can even go below 5%, above 5%. But it did not happen. We saw that finally it started declining. In the month of December, you can see here slowly lower tops happened in USD INR. And we saw that it happened because the current account deficit also was coming down. Forex reserves in India, we have seen a good revival, because if you remember from almost 600 plus levels, $1 billion, it declined to 530, and now again it is reaching towards 600. Previously, it was almost close to $640 billion. Now it is somewhere close to $600 billion, but it has definitely revived from the lower levels because of these flows which are coming to India now. Finally, if you look at the agricultural sector, because so far what we were saying in India that the rural area is in distress, they have not been able to perform, and we have seen now some kind of growth coming up. So my feeling is that El Nino was discounted to very much to the negative, and we have seen the two-wheeler numbers also are coming good, and you can see here the agriculture GVA growth, gross value added, is continuously getting better. So I think it's a very good sign for India now that its broader agricultural market is improving, and which can lead to more consumption stories to participate actually now going forward. So that's all from my side now. If you have any queries, you can ask me. Let me see if someone has raised any query now, so we can answer on that. So there is a query on the power space, that what is the outlook on power in India now from here. So we believe power space is likely to remain, go for re-rating now, because you have already seen a very long period when the state electricity boards, they were in deep losses in India. They were not able to purchase power. And that is where, if you look at tier 2, tier 3 cities in India, there was some of the for very long period of time, the dark lights were not there. And now the things are recovering, because we believe the state electricity board losses are reduced by 45%. The government compliance on power actually has improved. The same way they have been compliant on taxes and GST, and the numbers improved over there. They have been compliant on power. So many things are happening which are improving the balance sheets now. And this is where the whole power space, and some of the companies now which were in thermal or hydro, they are moving into renewables. This is where I think the re-rating can happen, and then lately they can start selling the stakes in those renewables parts. So I think power definitely is looking better now. Some of the names can revive going forward. I will not be able to take stock-specific recommendations. If you can ask me more on the sector-specific, then I think it is better for me. So there is a query on cement space. In cement, because despite so much of infra spending by the government, because it was more a government capex, we did not see the cement companies participating, and the reason was that previously the raw material prices were higher in cement, and now they have come down, but they were unable to increase the output price. So in the month of January, we saw the output price increase, but then it was rolled back. But if you see the numbers now in the recent quarter, we have seen there is a good volume growth. 97% of capacity utilization. The input cost has come down. So this is where some cement companies actually are able to revive. I think it's a good thing. At least the bottom possibly is made, and some kind of reversal in the cement pack can be seen now. But another thing I would like to add here, that if you look at the overall supply, as I discussed during the presentation, it is going to be much higher than the demand overall. So in that case, it is always better to look for some B2B companies. The companies, for example, AIA Engineering, if I have to quote any name, then these kind of companies which are in high, chrome grinding mills, so they are the providers to all the cement companies. So this is where B2B can revive, can recover much faster now than the original equipment manufacturers. So I think I have covered the sector specific. Yes, one question is on the IT sector now, whether we should look at the upper end of IT stock. So yes, the large cap IT is definitely getting attractive in terms of valuations, but in terms of growth, it looks like it can take some more time, because it is more dependent on BFSI space outside, which is under distress. It is more dependent upon the retail space outside, which is also not showing any major growth. It is also dependent on the high-tech IT, where some recovery has to be seen. But yes, when the S&P numbers or results are expected to be better from Q3, I think we need to remain hopeful that more severe downsides may not be there now in IT pack. You may have to wait for some time. That is very much possible. But the larger names, their valuations are much better right now. And this is where I think some kind of long-term investment can be done. But you may have to wait for some time, because these are globally linked sectors. And where we are focusing more, it is the domestically linked sectors, where more growth in the near term is also expected. So that is all from my side now for this particular webinar. Thank you very much. We will meet again next month with the next monthly outlook going forward. So that is how it is. We have discussed certain sectors. We have discussed certain stocks today. And so have a good investment period going ahead. So thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.